Good evening, everyone. My name is Paul Young. I'm just going to walk you through the Ontario debt. I did a recent video many months ago, but I want to take it through more to the sensitivity side of the Ontario debt to let people know what could be impacting Ontario down the road. Now, this particular chart shows you that when Ontario first, in terms of debt to GDP ratio and the total debt, Ontario's debt is close to $300 billion. So we're up to almost like 40% of GDP. That's significant. Now, remember what debt is. Debt is tomorrow's taxes or spending cuts. Despite what Kathleen Wynne and the Minister of Finance, Charles Sousa, say, it's a big issue. They can sweep it under the table all they want. Debt is an issue. At some point, debt is going to relate to spending cuts. It also means that the third largest expenditure in the Ontario government is debt servicing costs. That means money that can't be used on healthcare, education, or other social services. This graph shows you now the debt service charge. So we're up to close to $12 billion a year annually in debt service charge. We keep adding to that, so as more the debt grows, the more the debt service charge is. Now, the only thing that saves Ontario right now is low interest rates. But if interest rates go up, that's going to impact. Credit rating. Now, when the government of Ontario goes out and raises debt on the open market, it's based on how they rate their bonds. So if the bonds are downgraded, that means the investors are going to ask for a premium for those bonds, which will push up the interest rates for those bonds, the yield. Now, that's not something Kathleen Wynne or Charles Sousa talk about, but it's a significant thing. The other thing too is when you do with Moody's or Standard & Poor's, they actually will do an assessment of the government's debt ceiling. And at some point, those bond agencies will tell you that Ontario is almost hitting their debt ceiling level. What's that mean? It will be much harder for them to raise debt. And when it means much harder to raise debt, that's going to impact their operating cash in terms of running their day-to-day operations. So they can sweep this under the table all they want because they're typical with liberal parties. They play a game of smoke and mirrors. They basically tell you they won't cut, but they are actually cutting. They won't tell you the impact and sensitivity of interest rates or sensitivity of the debt ratios. They won't tell you that. Now, this just gives you an idea of a bond rating things, and it tells you from a AAA, it's exceptional, down to a C rating, which is poor. When you start seeing downgrades, these impact the government's ability to raise income, debt within the markets. And then when they raise that, that means it's the bond valuations. Now, this is showing you what basically the Ontario credit rating system works in terms of the bond yields. And you're seeing Ontario there in terms of what some of the bond yields are. Now, that's recent debt that they've issued recently within the next couple of years and when it comes to maturity. So any new debt will be impacted by the bond ratings. Now, this just gives you an example of a sensitivity analysis on debt charges, right? So you can actually see that maybe even with a debt ratio, when you see a change in debt ratio, the debt rating system, you could see maybe close to $500 million to $1 billion in new financing charges just added based on the debt ratings. That's not something Sousa or Kathleen Wynne talk about because they don't want people to know what can impact the overall debt schedules. Now let's talk about a couple things right now. Now, this is Ontario. What I basically did is I used the RBC, did a forecast. And basically I'm using projection numbers of GDP growth, of real growth of 4.5%. Okay? I'm also showing you where they're trying to target basically the elimination of the deficit by 2017 or 2018. Now, that being said, there's no indication that the government's going to do huge spending cuts. They're driving it based on GDP growth numbers and new revenue streams, whether that's the carbon tax, whether it's the Ontario Registered Pension Plan, but that's not going to impact revenue. It'll impact debt obligations in terms of using that money to finance transportation projects that they're doing. But they're basically holding the line on expense growth to 1% or lower. Now, that's only going to work so long before something happens. The other thing that's not told about the Ontario government, the actual debts are actually higher if you bring in the unfunded pension liabilities, which are close to $80 billion. that has to be paid as well. Kathleen Wynne does not even talk about the unfunded pension, and there's other obligations too as well. So what Kathleen Wynne is doing is quick fix things. She's sold off part of Hydro One to fix some of it. That's a one-time gain. She's going to lose that revenue from that operation, as part of it is part of the operational revenue coming in. The other thing too is she's upselling services to LCBO to expand the revenue, which will allow them to expand the dividends. So she's looking at different ways to maximize revenue, which is a smart way in a roundabout way, but some of the stuff is a one-time hit. The other thing is she hasn't done cost control. She hasn't looked at the size of government other than hold the line on wage freezes. So she's playing a dangerous game of basically trying to hope the economy will bail her out. Now, I did a sensitivity analysis here. So basically, in order to bring the debt ratio down to 22% over a 4-year period, so if the new government comes in 2019, I basically say they have to generate about 46, close to $50 billion in surpluses. And how do you generate that? Well, you have to bring in revenue, and then you have to drop cost. So I estimate they will have to make cuts to about 14-15 billion a year. Now, that means possibly 200,000 government jobs. It could mean more cuts to services, like frontline nurses, teachers, all that. They're delaying potential cuts to future governments. Wynne is not stupid. Wynne knows this. What she's basically doing is playing a dangerous game. At some point, the next government coming in, which likely will be possibly a conservative government, is going to have to be forced to do deep cuts and austerity measures. That's what happened when Mike Harris took office with the common sense revolution to bring things down, to fix what Bob Rae left. The mess that Ontario leave is so deep in terms of from the power issue to the hospitals to the overall administration of government are critical that has to drive that. Plus, with the Wynne bringing in bad, damaging economic policies that drove business out, it's going to be very difficult to do that within one term. It'll probably take 2 terms, maybe 3 terms to fix the mess that Kathleen Wynne's government has left here, as long as Dalton McGuinty. So what you people need to understand as you move forward and look at this stuff, you need to be very critical that when government's trying to raise revenue, it doesn't necessarily mean that's going to work unless you counter the size of government. Not once has this liberal government ever dealt with the size of government, including looking at all programs. Whatever this government's touched, it's gone bad in a hurry. So you guys, when people are watching government, whether it's Ontario or federal or different provinces, they should look at how these governments are operating. The more they raise debt and deficits, the more they're going to have issues with future tax and spending cuts. Thank you.